Another day, another story. Capital budgeting and investment analysis are crucial financial concepts that businesses and individuals use to evaluate potential investments. Capital budgeting involves analyzing long-term investments, typically involving large sums of money, and determining whether or not they are financially feasible. Investment analysis, on the other hand, involves assessing the performance of an existing investment, as well as the potential of new investment opportunities. Capital budgeting typically involves 4 stages: identifying potential investments, gathering relevant information, analyzing the information, and making a decision. During the identification stage, companies or individuals will consider a range of investment opportunities, such as new equipment, buildings, or other long-term assets. Once potential investments have been identified, the relevant information is gathered that includes the expected costs of the investment, cash flows over the life of the investment, and the expected rate of return, (ROE). It may also include information about risks, such as changes in market conditions, regulatory changes, or competition. The next stage involves analyzing the information to determine whether the investment is financially viable. One common method of analysis is to use net present value (NPV) calculations. NPV involves estimating the expected cash inflows and outflows over the life of the investment, and then discounting those cash flows to their present value. If the NPV is positive, then the investment is expected to generate a return greater than the required rate of return, and is therefore considered financially viable. Another common method of analysis is to use the internal rate of return, IRR. IRR is the discount rate that makes the NPV of the investment equal to 0. If the IRR is greater than the required rate of return, then the investment is considered financially viable. Let's take an example to understand capital budgeting and investment analysis better. Suppose that a company is considering purchasing new equipment for its manufacturing plant. The equipment costs $100,000 and is expected to generate annual cash flows of $30,000 for the next 5 years. The company's required rate of return is 10%. To determine whether this investment is financially viable, the company can calculate the NPV. Using a discount rate of 10%, the NPV is $12,136, calculated through putting values in formula. Since the NPV is positive, the investment is considered financially viable. The company can also calculate the IRR to determine the expected rate of return. Using the cash flows and the initial investment, the IRR can be calculated to be approximately 17.6%. This is greater than the required rate of return of 10%, so the investment is considered financially viable. Investment analysis is a similar process, but instead of analyzing potential investments, existing investments are evaluated. For example, an individual may evaluate the performance of their stock portfolio to determine whether it is meeting their financial goals. This could involve analyzing the returns generated by each individual stock, as well as considering overall market conditions and economic trends. Capital budgeting and investment analysis are essential financial concepts that businesses and individuals use to evaluate potential investments. By carefully analyzing the expected costs and cash flows associated with an investment, as well as considering the potential risks and benefits, investors can make informed decisions about how to allocate their financial resources. Thanks for watching.